Hello, this is John Cavalli of JK Financial, and I have a special guest here helping me. Her name is
Sophia.
that's my daughter for those of you that don't know. Wanted to be pretty quick in this month's video, but I had a couple important things that I wanted to talk about. First of all, our new planning tip of the month was well received last month, and we thank everyone very much. This month's planning tip comes from repeated discussions that I've had already this year, and that is about the 401k. While it's tempting and the intentions are good to try and fill up that 401k early, I prefer, we find that it's better for investments long term, aka dollar cost averaging, to go ahead and spread those contributions out. You can see the cursor here. You'll see that we like it's likened to dollar cost averaging. We also have included on our blog site here a tax cheat sheet. So if you're not exactly sure what the limits are, click there where my cursor is right now, and it will show what the limits are. So I got a little cheesy here, and I said, all right, one other added tip. We focus on 401k so much at the turn of the calendar because folks have adjustments, and a lot of the companies change different investments. But when you first are starting a 401k, it's good to have it be very aggressive. And the reason being is because the money that you're putting in makes up the majority of it. So spread those payments out evenly and be aggressive when you first start. All right, my helper's gotten bored already here, but we'll move on. So I'm going to pick up some pace here. We've got 2 strikes on non-farm payroll. We're really watching this, and the question is it the winter vortex that has slowed hiring down? As a quick review, non-farm payroll is hiring. What the economy is hiring new people to do things, employment. In January, we're looking for close to 200. We came in at 74. I thought that would be revised way up. It was revised up to 75. Not a big move. February, we were looking for 180, and we came in about 120. So later on this week, March 7th, we do get our next reading, and I would expect and hope that it would be much better. If it's not, this economy is slowing down for some reason, and it's not just a polar vortex. All right, I couldn't handle it anymore. I had to put some interest rate doo-doo in here. I know that there's a lot of folks that don't believe in these charts and things of this nature, and I address that because a lot of people don't believe in momentum in a football game because you can't see it. What is it? Well, the fact of, and basically this is a chart where I've drawn 2 trend lines here on the upper boundary of the interest rate. This is the 10-year Treasury. It's around 3%, and the latest lower boundary. Now you can see this is going back to May. May time frame is when we started in this zone here. What would possibly, and I'm not going to talk about that much more, but what would possibly happen is if we break out below this, it may go farther, and if we break out above it, it may accelerate. The concern here is that if this breaks to the lower side and goes down, again, something it would possibly be a precursor to the economy slowing again. Not ready to make that call, but we're watching very carefully. Lastly, the year of the buyout. Whew. This is the year of the buyout, it appears right now. And the reason being is we've had a ton of buyouts already announced. So that is a very positive item because that means managers are getting a little bit more confident. So we hope you enjoyed this quick video, and we thank you for your time, and I thank you for my helper.
Yeah.
Have a good day, and we will talk to you in a month.